Good morning, everyone. Hope everyone is healthy, happy. We are going to continue moving along. And today we are going to complete the chapter on the statement of cash flows, again, which is chapter 13. As I've mentioned on the announcements section of Blackboard, we are going to be having our quiz on this chapter on November 10th. Okay, so we are rapidly moving along with this semester. After we complete the slides and the homework for chapter 13, we are going to then do a partial chapter, which is chapter 7, okay, which is on accounts receivable. And then finally, we are going to start the last section of our class, which deals with, which now we're going to look at the managerial accounting reports. Okay, so that is what the rest of the semester is going to be looking like. Please note that the quiz on November 10th is going to be given during the first half hour of class on McGraw-Hill. Okay. All right. Oh, so let's look what's happening to our stock investment. I'm sure that you're all aware that there's been a spike in the coronavirus, the number of cases again. So that has had a negative effect on the stock market. When we met on Tuesday, our Apple share was trading at about $116.20. As of right this second, it is trading at $113.68. Okay, now Apple again basically declared what its quarterly earnings were, what their sales of their iPhones. Now they're coming out with an iPhone 12. So they have more strength than other companies possibly in the other sectors of the economy. But again, they are suffering also. The market price of their shares has also fallen somewhat. So something to be looking at, something to be interested in. Okay, the next couple of months, honestly, are going to be tough. Okay, just in terms of there's going to be more closing downs of businesses. Unfortunately, unemployment rates are going to be increasing again. What you have to do as young students is just stay focused. This is the best you can do, is invest in yourself. Okay, stick with it. All right, everything is still going to be online. This is a time where you really have to focus and say, there's nothing else going on. I'm going to turn inwards. All right, so please keep that in mind. Don't give up. Don't get depressed. Stick with it. All right. So, all right. So we were dealing with the statement of cash flows in this chapter, okay? And we have completed, remember when we talk about the statement of cash flows, the mnemonic that I had mentioned to you, the easiest way to remember it is, okay? Operating, investing, financing, the three required sections for the statement of cash flows. Now we've gone over the operating section, we've gone over the investing section. We have one section left, which is the financing section. Okay, so again, what we're going to be doing is looking at changes in the balance sheet accounts, specifically in the debt section and in the equity section. Okay, so we're looking at the changes in the accounts in that particular, on the right-hand side of the balance sheet. Okay, and in particular, we're looking at changes in the following accounts. Okay, changes in bonds payable, changes in notes payable, changes in the common stock and capital stock accounts, common stock, common stock, preferred stock, and the paid-in capital accounts. Because remember, when preferred stock and the paid-in capital, related paid-in capital accounts. Remember that when you are completing the statement of cash flows, you are thinking purely cash. Okay, you have your focus on cash. All right. And finally, the last account, which you're going to be interested in the changes in as you're doing this particular section, is the dividends account. And again, this is going to be the dividend paid account. Okay, because remember that little tricky point. If a corporation receives dividends, any dividend receipts, since they're considered in net income, any dividend receipts are also then going to be included in the operating section, not in the financing section. Only when a corporation pays dividends on its own shares of stock, whether it's preferred stock or common stock. Okay, and again, we're going to see in a little while, it's not just declaring the stock. Okay, because if a corporation declares a stock dividend, remember that doesn't necessarily mean cash was paid. Okay, you have to look at the change in the related dividend payables account as well. Okay, and also just keep in mind that when you're dealing with any of the sections, the operating, investing, or financing section, in addition to the current year's income statement, 2 years balance sheets, you're also going to have that section that is called the additional information section. Okay, and usually you can get all the necessary information from there. Okay, because a lot of the changes, remember, when you're looking at a balance sheet account, you're looking at the total, okay, the balance in that account, that particular date. Okay, if you really want to know what the changes over time were, you can't get that from the financial statements. You'll have to look at the general journal, the general ledger. So that's why the additional information section gives you all the detail behind that. Okay, all right, so let's move forward. All right, so the first thing that we're told here in Allison Corporation, they had proceeds from issuing bonds payable and capital stock. All right, so the first thing we're told is Allison Corporation received cash of $100,000 by issuing bonds payable. Okay, and again, this amount was determined by, they looked at the changes in the bonds payable account. Okay, and we also, you're told here that there were no debits to the bonds payable, meaning that no debt was bought back over the course of the year. Okay, so whenever a corporation issues bonds payable, is that going to be a source or a use of cash? Anyone? When a corporation issues bonds payable, remember, it's going to be a source. Excellent, Daniel. Okay, because remember, when they're issuing, that means, very good, Denise, that means that they are selling. Okay, so it's going to be a source of cash in the financing section. Okay, so we know already $100,000. Okay, in addition, Allison Corporation issued capital stock for $50,000. Okay, now it doesn't matter, okay, that the par value of the shares were $10 per share. Okay, what matters is the total cash inflow from this transaction. Okay, so we're not just looking at the amount that was capitalized in the common stock or the capital stock account, we're looking at the total cash inflow. And the total cash inflow from this transaction equaled $50,000. Okay, so we're going to have an additional source of cash on the statement of cash flows for $50,000. Okay, let's see what else we're told here. All right, now, Allison Corporation also declared and paid, and again, this is the key, they declared and paid dividends of $40,000 this year. Okay, since they paid dividends of $40,000 this year, this is going to be an outflow or a use of cash, okay, when they pay dividends on their own stock, regardless of whether it's preferred stock or common stock. All right. But what you have to remember, the tricky thing with dividends is that here, in this instance, the dividends were declared and paid during the same year. Okay, so that means the $40,000 that was declared, that was the same amount as the cash outflow. Okay, however, if we saw that dividends were declared, okay, so let's take another example. If we saw that dividends were declared for $40,000, if dividends were declared for $40,000, we'll keep that the same. However, during that same year, we also saw an increase in the dividends payable. Okay, so remember, just like when we were looking at the other expense accounts, if we saw that dividends payable, however, that account, that liability account, increased by $10,000. Okay, in that instance, what would the cash outflow from dividends be for this year? Okay, given this second situation, okay, they still declared dividends of $40,000, but the liabilities went up for $10,000. Dividend liabilities went up from $10,000. What would the cash outflows then be for dividends that they report on the statement of cash flows? Anyone? It wouldn't be $40,000. Why? Because remember, what happens if the related payable account increases? Okay, what does that mean? Very good, Manpreet. It would be $30,000. Daniel, very good. That means the amount of dividends or the cash outflow would be only $30,000. Okay, because they declared dividends of $40,000, but they only paid dividends of $30,000. And how do we know? Because of the fact that the related payable account, the dividends payable account, since it increased by $10,000, that means the amount of cash paid for those dividends of $10,000 was not made for this particular year. Okay. That's exactly right, Rachel, because there's leftover dividends that are going to be paid in the next year. Exactly. Okay, so you always have to look with any of these expenses or dividends accounts, you always have to look at the related payables. Okay. Now, let me ask you another question. Okay, what if I told you that Allison declared dividends of $40,000? Okay, same basic scenario. If dividends were declared for $40,000, okay, during the current year. Oops. However, okay, over the course of the year, okay, dividends payable decreased this year by $5,000. Okay. If dividends were declared for $40,000, and again, when in doubt, always go back to the journal entry, okay? Especially with the statement of cash flows. When a corporation declares dividends of $40,000, remember that's the first date in the life of the dividend. Okay, so here, what are they going to do? The corporation would debit the dividends account. Okay, for $40,000. And then which account is going to be credited on the date of declaration? Dividends payable. Of $40,000. All right, If I told you, however, that dividends decreased, the dividends payable account decreased by $5,000 over the course of this year, okay, what was the cash outflow then? Okay, in this scenario, okay, 45,000. Excellent, Lysander. Casey, excellent. It would be 5,000 then, Shuling. Excellent. Okay, why? Because not only did the corporation pay the $40,000 in dividends that they declared this year, but they also paid off a liability from the previous year, okay, for dividends. Maybe they declared dividends at the end of the year, and they didn't actually pay the cash out of those dividends this year. Okay, so again, it always goes back to look at the related accounts that appear on the balance sheet. Okay, remember that this really, this is financial statement, the statement of cash flows really tests your knowledge, okay, of accounting up to today. Okay, so you always have to reverse it. Okay, since we're unaccruing all the accounts, look at the journal entries when you're in doubt. Okay, very good. All right, ta-da, now we finally have the last section. Remember, this is the financing section. Whenever you're preparing a statement of cash flows, you're never just going to net these figures. You're better off spelling out every source and every use, okay, of cash that you're unaccruing. All right, so here the first thing that we looked at, when the corporation sold more bonds payable, okay, for 45,000, that was an inflow of cash, okay, that was from the sale of bonds payable. Now let's just think of it, okay, if a corporation sells bonds payable, what's happening to cash? Okay, you know that cash is increasing, it's an inflow. What happens when payments, you see where payments to settle short-term debts, they're retiring some of their bonds payable, okay, you know that that is going to be a use of cash. So the first one is a source of cash. All right, the second one is a use of cash. Okay, so Casey, why did it even say, so why does the dividend section say 40,000? No, in our instance, I'm sorry, I was giving the two examples I gave Casey were additional examples. Okay, for the example we had here, okay, they declared dividends and they paid dividends of $40,000. So here they declared and paid dividends of the $40,000. I just wanted to go through with you what happens if they didn't pay the full amount of the dividend, or they paid an outstanding dividend from the previous year. Okay, so that was just two other examples. Okay, good question though. All right, so proceeds from short-term borrowing, we know that's a source of cash. Payments to settle short-term debt is a use of cash. And remember, whenever you're putting the schedule together, put brackets around the payments, okay, or the uses of cash so you don't make a mistake. Okay, okay, I'm sorry, so these were notes payable. Here now are the proceeds from bonds payable. So proceeds from issuing bonds payable, again, that is always going to be a source of cash or an increase of cash. Okay, all right, so that was a source of cash, $100,000. Now, okay, proceeds from issuing capital stock, again, the amount that was credited to the common stock account was $10,000, okay, but remember, we're looking at the total cash that was received. And since that stock was sold for a total of $50,000 cash, that's the amount, the source of cash, the total amount of cash for $50,000. Okay, because remember the dividend here, I'm sorry, the journal entry here on the date that that stock was sold, there was a debit to cash of $50,000. Okay, and then a credit to common stock because it had a $10 par value. There there was a credit to common stock for $10,000. And then we know where does the difference between the cash received and the legal capital in the common stock account, where does that get credited to? We know, going back to Accounting 101, we know it gets credited to the additional paid-in capital account. Okay, just a little bit of a review of a journal entry, but remember here for this statement, don't get confused, we're only dealing with cash. So what was the amount of cash that was received? The cash that was received was $50,000. Joshua, where do these numbers come from? Is it just for this example, or are we expected to? No, you can't. Okay, so typically what's going to happen, so remember what I just said, that when you're doing the financing section, okay, you're looking at the changes in certain accounts, okay, and the certain accounts are bonds payable, notes payable, common stock, and dividends. Okay, and I'll end, so just keep that in mind. And Joshua, I will get back to your question in 1 minute. Let me just do the dividends. Okay, so the last thing that we see here, okay, in the financing section is we were told, okay, that the dividends were paid, declared in this year of $40,000. Again, that is, that is always a use of cash. So what was the change in cash this year for the financing section? The change in cash equals $100,000. Okay, and it's a cash inflow of $100,000 from financing. Okay, and now Joshua's getting nervous. He's like, wait a minute, but where am I deriving these numbers from? Okay, slide 42 and even more specifically, slide 13. Okay, Gerson, yes, very good, in slide 32. But let's go back to that additional information section. Because remember, the additional information section always provides a lot of information that was recorded in the journal entries, okay, and in the general ledger. Okay, and remember, you need 3 pieces of information to complete the statement of cash flows. Okay, you need the income statement for the current year, you need the balance sheet, and you need the you need 2 years, I'm sorry, the balance sheet for 2 years and the section additional information. Okay, so here, all right, here, this is the additional information section for the financing activities. Okay, so here, the first thing that you're told, okay, is that, and again, this will all, the additional information always assists you walk through, Joshua. Okay, so here, during the year, Allison Corporation borrowed $45,000 cash by issuing short-term notes payable. Okay, so that's where we got the notes payable change. Again, and also, okay, the company also repaid $55,000 in principal amounts on these loans and other notes payable. Okay, now the problem is, had we just looked at the balance sheet, we would just see under notes payable, we would just see a $10,000 difference, right? A $10,000 difference in that account. Okay, what the additional information section does is that it tells us how those changes in the accounts came about. Okay, does that make sense? So Joshua, always, you have to know which account that you're going to look at. Okay, yeah, absolutely. You would have to always be given the additional information. That's the third piece, the critical piece. So I would always just work off of that. Okay, so again here, this is how from this section, this is how I knew the details behind the $10,000 change in the short-term notes payable. Okay, and then when I knew that this was the $10,000 issuance of bonds was an increase in cash, the $55,000, again, repayment. I'll have my blinders on for cash. The $55,000 payment is always going to be a use of cash. And then here, the company sold bonds payable for $100,000 cash. That's a source of cash. And here, okay, this is the tricky one, or a little bit tricky. The company issued 1,000 shares of $10 par capital stock for $50 per share. Okay, remember, it's not $10,000 here. When we're doing the statement of cash flows, we're always thinking cash, cash, cash. Okay, so what is the amount of cash that was received here? The cash inflow from selling stock, $50,000. Okay, and then finally here, the last thing, cash dividends declared and paid to stockholders amounted to $40,000. Okay, so you would always rely, because if you just look at the balance sheet, you wouldn't be able to tell what the change is, why there's a change. Like in Allison, there was an increase in notes paid and short-term notes payable and a decrease. On the balance sheet, remember, you only get the net change. So the additional activity section is always a key. Okay, a really, really important section. Okay, so don't get panicky. You don't have to like derive these on your own. But just know that that's the information you rely on, especially for the investing and the financing section, right? Because, you know, from when you look at the operating section, you know, remember you start here with the operating section. You start with the income statement, and then you unaccrue the income statement based on the changes in the related balance sheet accounts. For the operating activity section, you don't quite need as much information, okay, but for the investing and financing section, you will always be given a lot of information, and just rely on that, okay? And that's always going to be the situation. Okay, so now we've been, all right, and again, you're only responsible for the direct method. All right, so now what do we see? All right, now that we know that there was a total increase in cash, okay, from the financing section, now we can prepare our statement of cash flows, okay, for this year for Allison Corporation. So what do we know? We know that in the operating section, okay, we have net inflow of cash, okay, of $50,000. Okay, we had a net inflow, and again, we worked through that earlier through the slides. Okay, so the operating section, and that's the most important section over time. Okay, because that's really that tells you the income from the underlying day-to-day operations of the business. Okay, now we also know, we went over last time, we know that in the investing section, okay, there was actually a net cash outflow. That is, the uses of cash were greater than the sources of cash. So we had a net cash outflow of $115,000. Okay. Then finally, we have the last section, and the last section is the financing section. Okay, and now we've just completed it. What do we see? We see the net results of the activities in the finance section is a net increase in cash of $100,000. Okay, so you really see here, all right, if you were a potential investor in this company and you see this information, all right, what would you think? Okay, the company has successful operations. If it's a shoe manufacturer, whatever type of company, you know they're making money, they're making net income, or they're making cash, excuse me, they're making cash, okay, based on the underlying activities of the business. That's what you want to see, okay? But you also see that the investing section, okay, basically has net cash outflows of $115,000. What does that mean? The corporation is investing in assets, okay? They're spending cash on building up the assets of the business. All right. Again, seems that this business is thriving, possibly growing its operations. Okay. And you also see that the corporation has net financing proceeds, okay, of $100,000. Okay. So what does this mean? The corporation, remember, is issuing debt and equity, okay, in order to finance its operations. So it appears that they're growing their business, they're financing growth in their business. That's where the money for the investments in long-term assets came from. Okay, and then what is the bottom line? Okay, when we add all these these three amounts together, we know that this corporation, Allison Corporation, this year had positive net cash inflows, okay, of $35,000. Okay, all right. So the cash inflows for this corporation were greater than the cash outflows of $35,000. Okay, so Dante, so as an investor, you would be looking more, yes, you would be looking, you'd want to see, you'd be very interested in the operating section, yes. Okay, and you'd also want to make sure that, okay, that you'd also want to take a look maybe in the investing section to make sure that the corporation is not selling off a lot of its assets, that is, it's cash poor, okay? So, again, so that's something that you would look at also. And where would you get from? There would be notes, okay? There would be more details as to the changes in these accounts. You would find it in the notes to the financial statement as well. But yes, Dante, to get back directly to your question, yes, as an investor, you'd want to make sure that most of the income is coming from the operating section. But remember, you're never just going to look at 1 year individually. You're always going to look at a trend analysis. Okay, and again, if it's a young company, okay, let's say if you were looking at Amazon, Apple in its early days, would you expect to see most of their revenues coming from the operating section? Probably not, right? Because they're a new company, they're just growing their business. Okay, so again, something that you have to look at, something that you have to consider, okay, the stage in life that a particular corporation is. Okay, good question, Dante. All right, and now Joshua, can you explain how the $35,000 was determined? Okay, what happened? Okay, when we looked at the operating section, okay, when we put together that section, we saw that the net cash inflows from operations was a positive net inflow of $50,000. Okay, then we completed the next section of the statement of cash flows, which was the investing section. And in the investing section, we saw that there was a net cash outflow. Okay, the outflow of cash in the investing section was bigger than the cash inflows. Okay, and how much were the cash outflows greater by $115,000. Okay, then we just completed the financing section, the last section of the statement of cash flows. When we added what all the net sources of cash were, what all the net uses of cash were, we saw that there was a total change in cash, okay, from the financing activity section of a positive inflow of $100,000. So the $50,000 inflow from operations less the $115,000 outflow from the investment section plus the positive cash flow of $100,000 in the financing section leads to a total change in cash for Allison Corporation of a positive inflow of $35,000. Okay, so what does that mean? Okay, Joshua, what does that mean? Okay, very nice. What does that mean? Can we tie that $35,000 into any account on the balance sheet? Okay, and the answer is yes. We're going to take that $35,000 and what does it tie into? It ties into what the change in cash was over this year. Okay, so Joshua, it all depends. If it's a negative, you have to remember, you have to look at whether it's a negative cash inflow or outflow from that section. Okay, again, and if it's an outflow, you subtract it. If it's an inflow, you add it. And it's going to be different for every single company. Okay, so here, again, very good. So here, remember, the first asset account that always appears on the balance sheet is cash. Okay, remember, unless a corporation has sufficient cash on hand, it cannot stay in business. So that's why this statement is really dedicated to explain what the change in cash was over this year. Okay, so what did we do? Basically here we see that what we're going to start with is the cash and cash equivalents, okay? Those instruments that are so close to cash that they're considered a cash equivalent, like available for sale marketable securities, remember that? So the amount of cash and cash equivalents at the beginning of the year equaled $20,000. And again, we get this from the balance sheet. Okay, then what else do we see? We see that cash and cash equivalents at the end of the year equaled $55,000. Okay, so the savvy investor is going to say to themselves, okay, where did this cash, this $35,000 in cash, where did this increase come from? Okay, and we could see here that when we did the statement of cash flows, the statement of cash flows, the change in cash of $35,000 came from, basically was based on the statement of cash flows. So the results of the statement of cash flows ties into the balance sheet accounts of cash. So you always know whether you did it correctly. Okay, and what's the detail behind that $35,000 change? It's going to be the change in the operating activity section, plus or minus the change in the investing activity section, plus or minus the change in cash from the financing activity section. Okay, and that is in a nutshell is what the statement of cash flows is for. And you always know that you can tie it in to the cash figure on the balance sheet, so you know whether you've done it correctly or not. Okay, and why is it so important? Because of the fact that, remember, if a corporation has a lot of credit sales, okay, and that means its accounts receivable are high, all right, that's what we're going to talk about in the next chapter. If the amount of their accounts receivable is high, but there's not a lot of turnover in their accounts receivable. Remember, a corporation cannot pay off its debt with an account receivable. The only way it can pay off its debt is with cash. Okay, so cash is king. That is the most important asset. So it's really important for a corporation to know, okay, where is the cash coming from? Okay, a corporation can't wait until they have no cash on hand to decide, uh-oh, we better sell some stock. Okay, they have to know when and how their cash is being generated in the business. Okay, all right, so we have completed now the statement of cash flows. We are going to go over the homework for this chapter. All right, and again, that's the worst. You'll see now when we're going over the homework, it's really not that bad. Okay, again, the first thing that you're going to say when you're doing any problem on the statement of cash flows, the first thing you're going to say to yourself is, okay, which section, okay, especially again when we get to the quiz, again, which section am I asking information on? Operating, investing, and financing. And then after that, you're going to put on your blinders and think, okay, I only am going to deal with cash, okay, the changes in cash for this particular statement. All right. All right, so let's look here. All right, this is brief exercise 3-1. And again, I posted these exercises, Casey. I know you're going to ask me, but before I'll beat you to it. I did post this homework on the materials in Blackboard. Okay, so you will see it there. All right, so let's do brief exercise 3-1. All right, and stick with me, okay? Again, it's always repetitive. While it seems a little overwhelming in the beginning, understand that the statement of cash flows is repetitive. It's always the same steps. Okay, so Presley Corporation had the following positive and negative cash flow during the current year. Okay, so look, they're telling you here for this particular example, they're telling you the positive cash flows and the negative cash flows. Okay, very nice. And now here, what is the question? Determine the amount of cash provided or used. Okay, so what is the net amount of cash provided or used? All right, so what's the first thing we're going to look at here? Cash received from customers. So realize here, okay, these amounts are already unaccrued, right? Because remember, if we were trying to figure out cash received from customers, okay, you would look at the net sales or the revenues figure, right? And then you would unaccrue that revenues figure by looking at the accounts receivable. Okay, here they've already done that for you. Okay, and again, the way you would think about that is, okay, we know cash received from customers, that's not a general ledger account. Okay, so here they ask you what is the net cash flow, the net amount of cash provided. Okay, so what are we going to do here? Which of these accounts changes cash? So here they're not asking for which section. This again is just like an intro exercise. So where did the cash come from? Okay, cash came from, does it ask you for the operating section? For the current year, determine the amount of cash provided. Okay, so here, let's just add this. It didn't particularly say this in this problem, but here it's only from operating activities. All right, so add this to your note. This particular problem is asking you, what are the changes in cash in the operating section? Okay, make sure that you add that. All right, so let's work through it. Okay, which of these items basically are included in the operating section? Remember, the operating section is basically summarizing the changes in cash from the day-to-day operations. What's the starting point for the operating section? Remember, unaccruing the amounts on the income statement. Okay, so we know cash received from customers. Okay, is that basically from the day-to-day operations? And the answer is yes. Okay, so we know cash received from customers, that is an inflow of cash in the operating section. Okay, interest and dividends. Does interest and dividends received, okay, does that get included in the operating section? Okay, and the answer is yes. Okay, so we're going to add, in addition to the $270,000 from sales receipts in cash, we're going to add the $50,000 of cash received for interest and dividends. Now, million-dollar question. What if the question asked, okay, what if the question asked, what about dividends paid? Okay, would dividends paid be deducted in the operating section? No, very good, Daniel, Dante, like you're very good, Jeffrey. Remember, dividends paid, that's the trick one. Dividends paid by the corporation always are deducted in the financing section. And again, it's because of the fact that dividends are not deducted. Yes, Dante, very good. As a use of cash in the financing, and that's because only things that affect the income statement and the net income are included in the operating section. Very good. All right, so let's move on. Sale of plant assets, no, that's not in the operating section. Where would the cash inflows from the sale of plant assets be included? Which section? Investing. Excellent, Daniel, in the investing section. Very good. All right, so let's move on. Now we're going to look at the negative cash flows. Okay, so here, amounts paid to suppliers and employees, yes, that is going to be included as a use of cash. So remember, put brackets around it immediately. Yes, cash paid to suppliers and employees is a negative cash flow. Okay, in operations, purchase of investments, no, that does not get deducted in the operating section. Again, that gets deducted in the investing section. How about purchase of treasury stock? Okay. Would the purchase of treasury stock affect any of the three sections? Remember, what happens when a corporation purchases treasury stock? corporation is buying back shares of their own common stock. Okay, so where would a purchase of treasury stock be included? Investing? Any other? Again, what is a corporation doing when it's buying back stock or when it's selling stock? Which section would that be? Not operating, because that's the day-to-day operations. Buying back treasury stock would not be included in the day-to-day operations. So by default, which section does it have to be? It has to be recorded as a cash outflow. Okay, excellent, Joshua, in the financing section. So remember that purchases of treasury stock are always a cash outflow in the financing section because it has to do with stock. It affects equity. Okay, it doesn't affect the day-to-day operations. It affects the equity accounts. Okay, so it would be deducted there. All right, very good. So what does this tell us? This tells us that in the operating section, okay, based on these transactions that were recorded here, what is the net cash inflow or outflow from operations? The net cash inflow equaled $193,000. Okay? And again, that's for operations. Okay? All right. Now, all right, we've exercised 13.5. All right, so Old South Company purchased investments for $55,000. Right away, you know, you can put little brackets around it, so because whenever you purchase investments, you know that negatively affects cash. Okay, they purchased investments for $55,000, and they also purchased plant assets for $147,000. Okay, during the current year, during which it also sold plant assets. Okay, so remember, when plant assets are sold, okay, that's always going to be an increase in cash. Again, we're thinking cash only. So they had they sold plant assets, remember, that had a book value of $66,000, but they sold it at a gain of $6,000. Okay? The company also purchased treasury stock for $78,000. We know it's always going to be a cash outflow. Okay, and they also sold a new issue of common stock for $523,000. Again, that's always a cash inflow. Okay, so now the question, determine the amount of cash provided or used. Don't make the mistake. What am I asking you for here? In the investing section, make sure you check, okay, and you verify which section we're talking about. So here we're talking about the investing section. So, okay, remember, that's the changes in plant assets, in marketable securities, okay, and in loans made and taken out by the corporation. Okay, so here, what would be considered of the above information? Paid for investments? Yes, that would be a deduction, an outflow of cash. Okay, for the investing section. Okay, cash paid for plant assets, again, cash is going out. Okay, so cash paid for plant assets, $147,000 reduction. And then finally, cash received for a sale of plant assets. Remember here, okay, you're a savvy accountant now, okay? So here, remember, while they sold plant assets for $66,000, and they sold it at a gain, okay, of $6,000. What is the amount of cash that was received? $66,000. Okay, so again, what was the book value of these assets? The book value of these assets was $60,000. Okay, but they were sold at a $6,000 gain. So the amount of the related cash they received was $66,000. Okay, and again, the wording here is a little tricky. It sold plant assets for $66,000. That's the price they sold it for, and that included a gain of $6,000. Okay. So, ta-da, now we have those 3 bits of information. Remember, treasury stock financing section. When they sell additional shares of common stock, again, that goes in the financing section. That's not what we're asking here. Here, you're being asked for the investing section. So be careful, read carefully. Okay, because you'll know the information, but you'll blow it because you'll give it the wrong in the wrong section. Okay, so again, you get to see here that it gets repetitive. While it is so overwhelming, it gets repetitive. Okay, when you're doing the statement of cash flows. All right, and again, the statement of cash flows is a required financial statement by GAAP. All right, every publicly traded corporation must prepare a statement of cash flows. Okay, so let's move on now. Brief exercise 13.6. And again, so here, look, this homework gives you a great example, okay? This is this is basically the summary for the operating section. This is a summary of the changes in the investing section. And now finally, we have the third section, which is the financing section. So very easily, you can compare and contrast the activities in each of these three sections. Okay, so here, New Mexico sold common stock for $560,000 and preferred stock for $56,000. Again, these are both sources of cash whenever stock is sold. Okay, in addition, the company purchased treasury stock for $47,000. We know that's always a use of cash. Okay, and they also paid dividends on common and preferred stock of $24,000. The key here is that that's the amount of dividends they paid. Okay, so here they ask, determine the amount of cash paid for financing activities. Focusing on the last section. Oh, here it is at the bottom of that page. Can you not see that? Oh, let me see if I could reduce that inside. Okay, so here. All right, so what is the first thing that we're looking at? The first thing we're considering in the investing section, we are going to look at cash received from common stock. Again, the nice thing is you always have to be told really the dollar values. Okay, but here now you just have to know which ones to include and which ones to exclude. Okay, so cash received from the sale of common stock, that is a source of cash, an inflow of cash for $560,000. Remember, we have our cash blinders on. We're looking at cash alone. So cash received from the sale of preferred stock, does that affect the financing section? And the answer is yes. It doesn't matter what kind of stock, it's still sold for cash. So that $56,000 is a cash inflow as well. Okay, now remember, cash paid to purchase treasury stock. Okay, the corporation is buying back shares of its own common stock. All right, what does that do to the cash balance? It basically decreases. This is a cash outflow, okay, that gets included in the financing section. And again, include the brackets, it makes life easier. Okay, and then finally, the last one, cash paid for dividends. Again, that is a cash outflow. All right, and cash paid for dividends, again, of $24,000. All right, so here we have all the cash inflow, two cash inflows, two cash outflows. What is the net change in cash in the financing section? And it's just on the next page. The net change in cash here is $545,000. That means it's a net cash inflow of that amount of money. Okay. All right, so each of these three sections, remember, is independent because different activities get reported in each section. Okay, but remember, ultimately, when you have all of those three sections of the statement of cash flows, they tie into the balance sheet. Okay, the changes in cash in the balance sheet. Okay, so it's pretty straightforward now that you have an overview of the whole statement. All right, now let's go to the next question, and this is brief exercise 13.7. Okay, again, all great examples for this chapter. All right, so here, Sphinx Company reported the cost of goods sold of $110,800 during the current year. Okay, following are the beginning and the ending balances of the merchandise and inventory accounts. So the biggest mistake some of you are going to make is you're going to move in the wrong direction. Remember, this is the ends of the year. This is the beginning of the year. So it moves in this direction. So if I ask you, what was the change in merchandise inventory over this year? Okay, what was the change in merchandise inventory over this year? Your answer would be $8,000 what? Increase or decrease? Increase, very good. $8,000 increase. Okay, always go in the right direction. Very good. Okay. Then you go to the next account. Again, we're comparing the beginning of the year to the end of the year. Okay, and here what happened? The balance in the inventory account increased. What about for the accounts payable? When we compare the beginning of the year balance to the end of the year balance, okay, what happened to accounts payable? Accounts payable increased by $9,000. Very good. So accounts payable increased by that $9,000. Excellent. Okay. So remember, when we are trying to determine, and here it says now, determine the amount of cash payments for purchases, okay, during the year. Okay, so what are we going to say here? Again, when we're trying to figure out what the cost of purchases were, right, we have to start, and again, this is going to be a use of cash, all right, and this again in the operating section. What is the starting point? The starting point is always going to be the cost of goods sold. So here we were told the cost of goods sold was $10,800. Okay, how do we unaccrue the cost of goods sold to arrive at the amount of cash paid for purchases? All right, we look at the change in the inventory account. Okay, and the way to think of this is, all right, we know that the underlying assumption is that the corporation paid for all the goods that it sold. It paid for the $100,800, okay, in merchandise sold. What else did they pay for? They also paid for the additional inventory they purchased. Okay, they purchased additional inventory. So here, that increase in inventory is added to the amounts paid out by the company for purchases. Okay, so the first assumption is any increase in inventory is going to increase the amount of purchases. Okay, however, okay, remember that some of these purchases, okay, and again, always go back to the journal entry, some of those inventory purchases, okay, you could have debited the inventory account. You could have debited the inventory account, but instead of paying for it, instead of crediting cash and paying for it immediately, what could have happened? They could have basically decided to pay off that inventory purchase over time. Okay, so remember, to unaccrue the cost of goods sold, what you're also going to have to look at is the change in the accounts payable. Okay, so what do we see here? We see that accounts payable increased, okay, by $9,000. That increase in accounts payable means that some of the additional inventory and actually some of the goods that they sold, okay, have not yet been paid for, okay, because their payables increased over the course of the year. All right, so any increase in accounts payable is deducted, okay? Any increase in accounts payable is deducted from the cost of goods sold to figure out the amount of cash, because we're trying to figure out the amount of cash paid for purchases. And oh my goodness, does anybody see a mistake here? Look, this is not financing activities. When we're talking about the sale of the amount paid for purchases, which section of the statement of cash flows are we talking about here? Very good, Daniel. The operating section. So make sure you correct that. That's operating, not financing. That's a problem in the book. Sorry about that. Okay, so that should be operating. Okay, and again, remember, that's when you're talking about the statement of cash flows. The first question is, okay, which section are they asking for information here? And then the second one is, okay, I'm thinking only cash. Okay, so what does this mean if I was trying to summarize what this particular section means? It means that basically what was the amount of cash that was paid, okay, for purchases this year. And again, that means there was a cash outflow. Okay, there was a cash outflow because purchases represents an outflow. Again, cost of goods sold is an expense, right? So that means that in the operating section, there was a cash outflow of $99,800 for purchases for purchases of inventory. Okay. And again, the starting point for purchases of inventory is always the cost of goods sold. Remember, the cost of goods sold is an expense. So here we're adding and we're figuring out the total amount of cash that was paid for that expense. So it's always going to be an outflow. Okay. You can assume that you're going to be asked to do this on, the quiz and on the midterm as well, because of the fact that it is a little tricky. But again, it's always the same thing. You always look at cost of goods sold, on accrue, look at the changes in inventory, look at the changes in accounts payable. Okay, and you're always thinking cash. Okay. All right, good. So let's move to the next exercise, and the next exercise is 13.3. Okay, so see, this chapter actually gets to be fun after a little while, right? I know you're thinking that. All right, so now, again, read carefully. An analysis of the marketable securities account of financial products tells you the following information. So remember, whenever you're dealing with assets, okay, there's a little trick here. Okay, so in the investing section, okay, when they're selling assets, okay, you have to remember a rule. All right, so here, let's just walk through this. What are we being told? All right, so the balance in the marketable securities account at the beginning of the year was $290,000. Okay, very nice. Now, what happened? There were additional debit entries to the marketable securities account. Additional debit entries. Remember, marketable securities are investments. All right, so what is the journal entry going to be when you debit the marketable securities account? You're going to debit the marketable securities account, increasing that asset account, right? All right, and then for the $125,000. All right, and then what is the credit to here? Unless we're told otherwise, we're going to assume that the credit is going to be to cash, okay, which remember is a reduction in cash always of $125,000. Okay, that's for the purchase. Now, however, all right, now we're told that there were credit entries to the marketable securities account. All right. Now, the marketable securities account, when it's credited, remember, just like any other asset account, it's credited when the asset is sold or reduced. Okay, so the marketable securities account was credited for $140,000, but remember, it's credited for the book value. Okay? And then you're told that the balance in the marketable securities account is $275,000 at year end. All right, so now let's think of this. All right, excuse me, that in addition, the company's income statement, and this is the key, whenever you sell an asset, okay, including marketable securities, you have to consider whether the asset was sold at a gain or a loss. Okay, so here we're told that the company had a $25,000 loss on the sale of marketable securities. Okay, all right, so let's look here. All right, always go back to the journal entry when in doubt. So what was the journal entry when the corporation sold marketable securities at a loss for $25,000? All right, the first thing you're going to do, all right, is you are going to debit loss on sale. Remember, because losses are just like expenses, they're included on the income statement. Loss on sale of marketable securities. Okay, and here again, you're told. Okay, the nice thing about this statement is that you have to be told all the details. Okay, because you can't just look at the balance in the marketable securities account and know this. Okay, you'd have to know to look at the income statement as well. All right, so loss on the sale of marketable securities was $25,000. Okay, you know that has a debit balance. Okay, what other account has to be adjusted? What other balance sheet account has to be adjusted? Do you think? Anybody? When you sell an asset, what do you have to do to that asset account? Are you going to increase it or decrease it? Okay, remember, what are we selling here? Decrease it. Very good. So what are we selling here? We're selling marketable securities. Very good. So we are going to have to decrease the marketable securities account. But remember, okay, what amount are we going to credit the marketable securities for? Okay, any asset account is always going to have to be credited for the book value. So here, we're told here that the book value of these securities were $140,000. Okay, that's what the, and again, that's according to the cost principle, right? We know that based on the cost principle, assets are always going to be recorded at their cost. All right, but now what are we going to do? All right, so we know we have a loss of $25,000. We know that we sold marketable securities. We have to credit that account for $140,000. So what does this transaction tell us? How much cash was received from the sale, okay, of these marketable securities? Anyone? How much? What was the cash? And again, why do I bother with the journal entry? Is it really that much fun? And the answer is you can always back into the amounts. Always rely on your journal entries, particularly for you who are going to go on in accounting. Okay, because when you can figure out what the change is going to be based on when you do the journal entry. So this is the journal entry when the corporation sold its marketable securities. It reduced its marketable securities account for the book value. It had to recognize the loss for $25,000. So how much cash? What was the cash inflow? Okay, what was the cash inflow? When these securities were sold, the cash inflow was $115,000, and that's what we see here. Okay, so what was the change in cash? All right, the change in cash basically was when there was a purchase of marketable securities for $125,000. Okay, so what were the changes in cash? Purchases of marketable securities were a net cash outflow, right? They were a net cash outflow of $125,000. And then what was the cash inflow from the proceeds? Remember, whenever there's a sale, the proceeds from the sale of marketable securities was $115,000. So what was the change in cash from the change in the marketable securities? Very good. $10,000 decrease. Excellent. Very good, Joshua. A $10,000 decrease. Okay, and that's why it's always good just to the brackets around it, so it always helps. Excellent. So you don't add the two together. Okay, and that's it. All right, that's it for this particular question. Good. So you guys are getting more familiar with it, right? Always thinking which section of the statement of cash flows, what type of transactions are recorded in that section, and then how does it relate to the change in cash. Okay. All right, so let's do the next one. Okay, the next exercise is 13.3. Again, if you can do these exercises, brief exercises, and the homework, you are an expert on the statement of cash flows. Okay. All right. So let's do the next one. The next question says, okay, computing. I'm sorry. The general ledger of AXM. Okay, the general ledger of this company AXM provides for the following information with regard to purchases of merchandise. Okay, so purchases of merchandise again. So again here, and please pay attention. Okay, so at the end of the year, the inventory account had a balance of $820,000. However, at the beginning of the year, I'm just going to erase this up here too. So, all right, I can erase this, everybody? Everybody has this? Okay. So at the beginning of the year, all right, so inventory at the beginning of the year was $780,000. At the end of the year was $820,000. So what was the change in the inventory account over the course of this year? What was the change in the inventory account? Okay, very good, Gerson. Excellent. It was an increase. Okay, and again, don't go in the wrong direction. Okay, it's from here to here. Okay, it's the reverse of what we did earlier. Okay, now we're flipping them. So you always have to pay attention, because you could do the whole problem, but you're looking at it in the wrong direction. Okay, so it was an increase, very good, of $40,000. Okay. And then the next part of the question, which is on the next page, and the accounts payable. All right, the accounts payable to merchandise suppliers. What happened in this account? Okay, the accounts payable from the beginning of the year to the end of the year. Anybody? Again, we're moving in this direction. So what happened to the accounts payable? The accounts payable decreased. Okay, very good, Gerson. It decreased by $70,000. Okay, so you know now, typically if you're dealing with inventory and accounts payable, you know that it's going to be a question that relates to how much cash was paid for purchases of merchandise for this year. Okay, and then here again, the starting point is always going to be, again, it's redundant. We've done it before. The cost of goods sold was $2,882,000. All right, so that's going to be our starting point here. And now we're going to try to unaccrue that account to figure out the cash paid for purchases. Okay, so here, cost of goods sold are at $2,882,000. Again, there was an increase in the amount of inventory from the beginning of the year to the end of the year. Okay, so what does that mean? That means in addition to the goods that were sold, okay, the value of the goods that were sold, the corporation also purchased additional inventory that's still sitting in their warehouse. Okay, so those were additional purchases for this year. So that is going to be increased. The increase in the inventory account is added to the cost of goods sold, okay, to unaccrue that account. Right, and again, this is, what are we doing here? Again, this is in the operating section, okay, and what's happening, we're unaccruing the cost of goods sold. So we start out with an expense account, the cost of goods sold, and we're unaccruing the expense by looking at the changes in the related balance sheet accounts. Okay, and then here we see that in addition, the second account that has to be unaccrued is the accounts payable. Okay, and we see here that what happened to the accounts payable? Accounts payable decreased by $70,000. Okay, so when in doubt, okay, what's the journal entry whenever accounts payable are decreased? Okay, again, just go over it when you're in doubt. Okay, account payable, I know it typically has a credit. So if I'm decreasing the accounts payable, What does that mean? That means I have to be debiting the accounts payable. Okay, what's the only way that accounts payable can be decreased? That's going to be if the accounts payable are paid off. So you're going to decrease it by $70,000. Okay, that means that's a use of cash, right? Whenever cash is credited, that is a use of cash. So here, that is going to be added as well, okay? That decrease in accounts payable is going to be added, okay, to the cost of goods sold, because that means there was an additional cash outlay. We're trying to figure out the amount of cash outlaid for cost of goods sold. So we add these two amounts, the $40,000 and the $70,000, to the cost of goods sold. And what does that tell us? What was the total use of cash, okay, for purchases of inventory this year? It equals $2,992,000. Okay, that was the total use in cash for purchases of merchandise over the course of this year. Okay, it's always the same formula. Again, you have to look at the related changes in inventory could have decreased and accounts payable could have increased. Okay, but again, you have to track the changes in those two accounts. And remember, whenever it's an expense account like cost of goods sold, that means that it's a net cash outflow always. Okay, questions? Everybody's good? Okay, let's go do the next and the last exercise. So now we're bringing it home. Okay, now you're going to understand everything there is. Okay, this is just a summary. I'm going to tell you a certain transaction. Okay, and you're going to tell me which section of the statement of cash flows does it appear in. Okay, does this transaction get recorded in the operating, in the investing, or in the financing section of the statement of cash flows, or does it not get recorded at all? That is an option too. Okay? All right, so let's start here. All right, and again, this should be becoming second nature to you now. Here, made payments on accounts payable to office supplies. Okay, again, that is always going to be office supplies expense. Excellent. It's going to be in the operating section. Okay, cash inflow or outflow? Inflow or outflow in the operating section? Outflow, very good. Okay, so don't get that part wrong. You'll get the section, but you have to know inflow or outflow. So I'll tell you the section, you tell me inflow or outflow. All right, so here, number 2. Pay the principal amount of a mortgage to a bank. When you pay the principal amount, okay, yes, it's an outflow, okay, and it's going to be an outflow in the financing section, okay, because again, whenever you have a note payable, okay, that's considered in the financing section, always. That's an outflow. Very good. Now, however, all right, what about when you pay the interest charges relating to a mortgage to Seventh Bank? Okay, again, paying the interest charges with regard to a mortgage to Seventh Bank, again, that is going to be in the operating section. Okay, so while the payment of the mortgage, okay, of the note gets recorded in the investing section, I'm sorry, in the financing section. Again, the repayment of the note is a cash outflow in the financing section. The payment of the interest with regard to that note is going to be deducted, a cash outflow in the operating section. Okay, very good. The next one, okay, and make sure you understand this as we're going over it. Okay, number 4. Issued, and again, that's the same thing as sold. Issued preferred stock for cash. Management plans to use this cash in the near future to purchase another company. Very good, Joshua Financing. And again, don't get tripped up that the fact that they're telling you, okay, we're actually going to use this to buy a building. It doesn't matter, okay, what the purpose is. Again, you're thinking only with blinders. And yes, it's going to be a cash in the financing section, Joshua. And excellent, Daniel. It's going to be a cash inflow whenever you're selling anything. Very good. Okay. Again, doesn't matter what the reasons are for. Okay. At least at the term when you're selling stock to the public. Very good. So number 5, paid salaries to employees in the finance department. Remember that the salary expense appears on the income statement, so that must be very good. That's going to be an operating expense, inflow or outflow? Joshua, when you pay salaries, inflow or outflow? Outflow. Very good, Joshua or Rachel. Whenever you see expense, you know it's an outflow. Very good. Number 6, collected an account receivable from a customer. Again, day-to-day operations. Okay, that's going to be reported on the as revenue on the income statement. So it is a cash inflow in the operating section. Okay, now here let's look at number 7. Number 7 is a tricky one. Number 7 states that transferred cash from the general bank account to a money market fund. Okay, so here, since they're not saying that the money market fund is tied into for a year, it's locked into that account for a year. Yes, remember that it's none of them. Very good. Whenever money is just switched between one bank account and another bank account, yes, you would report it, in the general ledger, the fact that it's transferring, but it does not affect the cash balance for the corporation. Okay, transferring between one account and another, it's not an investment of cash, so it would not be recorded on the statement of cash flows. Okay, unless it were an investment that was made. Very good. Okay, then number 8, use the cash received in number 4 now to purchase Moran Company. So now when they're using the cash, okay, and they're purchasing another company, okay, again, remember what is that going to be when you purchase, and that typically you're buying the stock in that company or the assets of that company if it's not a corporation, that's going to be included in the investing section. Okay, because you're investing in the assets or the stock of another company. That's a long-term asset, so it gets included. Is that going to be a cash inflow or outflow, though? When you're purchasing another company? Outflow. Very good, Gerson. It's always going to be an outflow. Okay, and that's all you have to do. Very good to remember to be able to prepare a statement of cash flows. Okay, this one is a good one. This goes back to your accounting 101 experience. Okay, number 9, need a year-end adjusting entry to recognize amortization expense. Okay, remember amortization, depreciation, depletion, okay, all of those non-cash expenses and adjusting entries also. Adjusting entries also don't involve cash. Okay, so remember that is an NA. It does not get recorded. An adjusting journal entry is not going to be recorded on the statement of cash flows. Okay. All right, let's go to number 10. Number 10 is, okay, at year end, the company purchased for cash an advertising spot on a local radio station for the next 8 months. Okay, the key here, okay, it doesn't matter. Remember, we're reversing the accruals. So they purchased for cash. There was a cash outlay this month, even though you're not actually getting, okay, the benefit of that cash outflow this year, okay, or this month. The fact that the cash is being paid this month means it's a cash outflow in the operating section. Okay, again, you have to reverse what the accrual was. So here, again, cash was paid, so it's not going to be prepaid. It's just going prepaid asset. Here, you're just looking at the fact that cash exchanged hands, and it's an outflow. Okay, because it's for a future expense. Okay, that one's a little tricky. All right, then number 11. Pay the annual dividend on preferred stock. Okay, again, whenever you pay a dividend, which section is that going to be in? Okay, again, that's a cash outflow, very good in the financing section. Okay, and then also when a corporation receives a dividend, okay, from their investments, which section is the receipt of the dividend also recorded in? When a corporation receives a dividend from its investments, which section is it recorded in? Anybody remember? No, Lysander, you fell for it. No, when they receive a dividend, remember which section? Not financing. Only dividends paid deducted as a cash outflow in the financing section. Remember, interest and dividend, excellent Daniel, excellent Rachel. Interest and dividend received on any of their investments is going to be included as a cash inflow in the operating section. So that's a little bit breaking the rules. And again, because of the fact that it follows the rules for the income statement. Since it's included as a source of net income, a dividend received is a cash inflow in the operating section. Okay. All right. All right. The next one. Oh, paid the semi-annual interest. Okay. On bonds payable. Remember, any interest payments, okay, are going to be deducted in the operating section as a cash outflow. Okay. Number 13, received a semi-annual dividend from an investment in the common stock of another company. And again, this is the tricky one that I just asked you. Okay, and again, number 13 is operating. Okay, it's a cash inflow to the operating section. All right. Then finally, number 14, and I don't know if you can see it here so clearly. I can't reduce it anymore. Number 14 is sold for cash, an investment in the common stock of another corporation. All right, so let's think about that. If a corporation sells for cash, right away you see cash. Okay, so you know it has to be on the statement of cash flows. Sold for cash, an investment in the common stock of another corporation. Okay, so then you know that it's going to have to be an inflow. Very good, Joshua, in the investing section. Okay, whenever whenever you see an investments like that. Okay, and again, if it were the corporation's own stock, okay, then it would be the financing section. But Joshua, very good. If it's the stock in another company, that's a marketable security or an investment that it's selling, so it would be in the investing section. Very good. And then finally, number 15, received cash upon the maturity of investment in cash equivalents. Okay, again, that one's a little tricky. You had, there was a maturity in your cash equivalents accounts. Okay, because of the fact that it was already in your cash equivalent account, meaning that it was going to probably, when at the time of purchase, it was going to become cash within the next 90 days. Remember, any investment that's going to become cash in the next 90 days gets included as a cash equivalent. So here the answer would be NA. It would not be included on the statement of cash flows. Number 15 does not affect cash because it's really already sitting in an account. Once it becomes cash, it's a cash equivalent. It doesn't change any of the cash flows. Okay, so that is a really comprehensive review of the statement of cash flows. So now you are all experts. Okay, so remember how you were first so intimidated and it was first so scary. Look, now it's you're all experts. Okay, and that's going to be the chapter again that we have our review on, but we have our quiz on. Okay. Let's tell what time is it? 11:40. You know what? I want you all to get ready to vote. If you can vote early, so I'm going to give you 10 minutes to go wash your hands, go run out and vote if you can early vote. Go look at the stock market. Let's actually see what's going on in the stock market now before I let you go. What's happening? Has there been any type of stimulus, news of any stimulus payments by the government? What's happening? Okay, so stock prices are increasing. The Dow is up a little bit. Okay. Okay, so jobless claims fell in the last quarter. Okay, so that's a good thing. That's always a good sign on the economy. Hopefully, we won't be seeing unemployment increasing again in the next few months. All right, so I'll let you go just 9 minutes early. Wash your hands, vote if you can. Stay healthy. Okay, remember the infection rates are going up, guys. This is serious. Okay. Yes, Lysander.
Regarding the balance sheet, is it always gonna have the words beginning and end on the top? Because in this one, the right was beginning and the left was end, but in the PowerPoint, the left was beginning, the right was end. That's what I was saying, like it's
It's
switched.
always going to be different. It's always going to be different, and it's going to be different just to trick you. So you have to make sure that's the first thing. Make sure you track the direction of the change over the year.
Okay,
Okay, so and it's going to be flip-flopped on exams. Okay, so you're going to have to make sure that's the first thing you look at.
thank you.
Okay, you're welcome. All right, everybody, have a healthy, happy weekend and day, and we will meet on Tuesday, and we'll start with Chapter 7, which is our last financial accounting chapter. Okay, and it's on accounts receivable. Okay, you're welcome, guys. Have a good weekend. Okay, stay home and study. All right. Okay, you too, everyone. Oh, happy Halloween. That's very true. Yes. Have fun. Eat lots of chocolates. That's all we can do, right? COVID way. Thank you. You too. Happy Halloween. Thank you. You too.